Well, good afternoon, Luke. It's my pleasure to welcome you to yet another conversation across the markets, particularly focusing on distribution. And it's my pleasure to introduce an old friend of mine, although he's very young, an old friend of mine, Luke Reeves, who's one of the founding partners over at LGBR Capital here in the UK, based here in London. Luke, good afternoon. How are you?
Very well, thank you. Thank you for the intro, particularly saying how young I am.
Well, yes. Well, you did pay me. Luke, for our viewer on this, we try and get an overview of what's going on in the markets, and particularly around the jurisdiction and the distribution within that jurisdiction. But before we get into that, could you just give our viewer a little intro to LGBR and what you do?
Yeah, thank you. So LGBR Capital, we founded about 10 years ago. Essentially, we're straightforward distribution. So some people class us as third-party marketers. We try and say that we're more of an outsourced sales team. We focus on the UK. About 90% of our flows come from the UK. And probably, what do we do that's a little bit different? We spend a lot of time around structure, about how we actually raise money, rather than relying solely on relationships. And the other thing is probably really our size. I mean, the UK is 23,500 firms. We're about 60 people. Probably puts us as one of the biggest, distributors in the UK, probably in Europe.
Yeah, you would be actually. I think probably across Europe. Yeah.
Yeah. So, that's it. And the main reason is that we believe that you want to go pretty deep into the market to actually give us a higher chance of raising capital.
Yeah, it's interesting. I mean, you've been established for, I say, just over 10 years now. I think you launched the same year that we launched Gemini back in 2009. So time has flown. The markets have changed. We've all evolved. Our businesses have evolved differently. But what do you see for investment managers coming into the UK? Some of the challenges. Certainly in light of things post-RDR, the landscape's fundamentally changed. What do you see for the challenges today compared to, say, 10 years ago?
I think clearly there's a lot more regulation. There's a lot more responsibility on know your client. And also, I think one of the big things that's underestimated is probably worth recapping. We don't speak directly to the public. We speak to what we would classify as the retail, or the wholesale retail, semi-institutional markets. They have a little bit of exposure to the institutional markets. But probably what everybody assumes is that we are speaking to IFAs, wealth managers, long-only fund of funds, stockbrokers. The level of due diligence isn't the same level. And I think a lot of managers underestimate that when they come in. And that's really just sort of meant that, 10 years ago, certainly 20 years ago, we could have a lot more reliability on us having our relationships with our clients. We still have the relationships with the clients, but the idea of please will you invest, my friend, that's gone.
Shame, isn't it, really? It is a shame. Yeah. A bottle of wine at lunchtime and there'll be a ticket waiting for you when you get back. They're gone, aren't they?
Yeah, they're long gone. And rightly so, but it is, they're long gone, and I can't see how they're coming back in any shape or form. Doesn't mean that we can't still have a drink, but it's now all about the due diligence that the investors do on the managers, how they compare. I think the other thing that's slightly forgotten against sort of the institutional market, if overseas managers coming in, is that that wholesale retail channel, they're pretty diversified. They're looking to build quite a number of managers within their portfolios because they're looking to sort of hedge for whole different environments. And we've got quite a volatile market environment at the moment. Our interest rates going up. Is inflation going up? Or if we just got another 3 or 4 cycles that might be finished over the next sort of by the end of the summer, and we're facing the prospects of recession. Where it is, you can either market time that, or alternatively, you can run a sort of broader portfolio with managers that should be able to do either well in all environments or in one particular environment. So I think you know, those are the big things at the moment for me. That is completely different to how it was before.
Yeah.
Also, investors are not as tolerant. Yeah,
True. That's true. And obviously, whatever it may be, it's maybe us getting older, but obviously the decision-making process, the people are younger. They're potentially, I would argue, they're probably a little bit more sophisticated. You know, the number of CFA charter holders at the fund decision level is significantly higher than it's ever been. So technically, you've got to be pretty strong, haven't you?
Yeah, I mean that is definitely so. And certainly, you know, what we're seeing is, I mean, look, you know, you can see that in education right the way through. I mean, my boys are 18 and 22, and crikey, you know, they know an awful lot, and also they're built to do exams. So then carrying on doing those exams and knowing a lot more about what they do from a fundamental perspective, just the future. So yeah, our way is a little bit different now, you know. But and also I think there's a lot more reliance, whereas, you know, a traditional sales chap could go in and say, look, I think it's going to be okay, don't worry about it, you know. That now, you know, we can talk to the prospective investors, we can highlight strengths and weaknesses and the like, but the majority of them, before they actually invest in something, they want to see the manager, whether or not through a webinar, you know, in our new world, or whether or not that's through a direct one-to-one. But yeah, these things, that there's a lot more work done at the beginning, because people are asking a lot more questions, a lot more detailed questions, and they still want to, you know, actually do that traditional. So I want to see the manager.
Well, that sort of lays into a good question, here, which is some of the do's and don'ts. I mean, fund managers come and go. Some come into the UK market with expectations. What do you think are the do's and don'ts for investment managers targeting the UK?
I think lots, really. Definitely do commit to the market. You know, the UK market is pretty diverse. It's a big market. It's the largest market in Europe. So, you know, which I think places it still sort of like the third or fourth in the world, you know. So, you know, that's important. So it needs to have a commitment. Investors are quite live to the fact that managers can come in and go. So, you know, do's are definitely commitment, and you know, commitment either means, you know, boots on the ground, or alternatively you outsource that, but long-term commitments to say that they're going to be here, because clearly, you know, people who are investing capital, what they're not, you know, in the UK, going through the intermediary market, it's not hot money. People want to invest and they want to ride the cycles, and they want to, you know, be where they are. Hence part of the reason why I said earlier, they're over diversified in their number of positions. So an investment incorporates making the decision at the beginning, but also the ongoing investor relationship that's going through. So if somebody comes over, you know, from overseas, stays there for a year and then disappears, that's really tough. So I think key things around that: do a lot of respect to the market. As we said, look, the DD elements are important and probably, as I said, underestimated. Yeah, those are key things. With regard to the don'ts, pretty much just the opposite. Yeah. Well, I think anybody just sort of comes in and has a, you know, sort of says, I'll come over here, play a bit of golf, and then turn around and go back and hope it will work itself out. That's just not gonna work.
So when you're looking at a manager, when you obviously talk to them about their do's and the don'ts, or you get a sense of it, what are you actually looking for when you're identifying a manager? Because it's as you said earlier on, it's an oversupplied market. There's differentiation is quite tough. When you're looking at a manager, how are you positioning them? How do you go about doing that?
So we have a number of things. So, you know, core components within the market, within the UK market, is that you need to be accessible to platforms, and you need to be aware that, you know, fee sensitivities in the UK are significant. So many overseas markets are very much, I'm not saying this is right or wrong, this is just what it is, as most overseas markets will be positioned on the basis that it's the performance that is the most important thing. And if you pay 100 basis points or 200 basis points to get to the performance, that's it. The regulator over here has very much got to steer towards past performance is no guide to the future, and therefore fixed costs are very important. So, sort of annual management fees of between 50 and 80 basis points can really, depending on how much alpha the actual fund is producing, sort of really what people expect to be paying for that. The more alpha, the more you can you can charge as a fee. But I mean, what do we want? Is we want them to be aware that, as I said earlier, but certainly we want them to be flexible with getting ready to deal with platforms. That's really important. We want them to be committed to supporting on the road shows, and we want them to be committed on the investor relations side.
So how often would you expect a manager, say from the US, to come over to the UK? I mean, I know we're in this Zoom world, but physically being in front of somebody, how often would you expect them to be here?
I'll answer it two ways. So if it was a UK manager, we would expect them to be looking to do, say, a breakfast and 11s, and then a lunchtime one day a month, and then available for probably half a day a month for investor relations type things. That's us asking questions about, was the market good last week? How well did it go? What do you think the future's looking like the next week, the next 2 weeks? Anything changed to your thesis? So that's really what we would expect. Now, if the manager is overseas, you would probably say that those once a month would turn into once a quarter, and those once a month would be replaced by webinars or Zoom. But still the same theory. So you do a webinar or Teams or a Zoom where you would literally look to do that, to do a breakfast for argument's sake, 8 to 10 people, do a larger one at 11 to, for argument's sake, 100. And then you would do, once again, a lunch for sort of, 8 to 10 people, and then a few one-to-ones either side.
Got you. And when it comes to, obviously, commitment to the market is critical, as you say. What about other things which are vital things, the strategy itself, but things like AUM and seed money when it's a new fund? I mean, these are clearly critical issues for you, I guess.
Yeah, I mean, look, perfect world, bigger the fund, better the track record, more outperformance, etc. The better prospect there is of you raising money, more of an identifiable edge. These are really, really important things. But in reality, if your fund is 10 billion and you've got, you're offering 200 basis points of consistent outperformance, high Sharpe ratio, then probably you don't need a sales team. So, what we're talking about really is that, anything realistically over about 50 million AUM will give you a good chance. If we look at it like there's 23,500 firms in the UK, very broadly about 9,000 focus on investments. They're investment related intermediaries, of which probably around about 25 to 30% will be very much focused on quant models, i.e. they will be looking towards past performance to stress test the portfolios going forward. So if you've got a short track record or you haven't got a track record, then it means that market is essentially ruled out until you can actually have a quantifiable track record. Yeah. When you're looking at the other element of that 9,000, so let's just for ease of numbers say that that's about 6,500 firms, then those firms would be looking more at a transportable track record. So what I mean is let's say they've got a US fund that's actually a 40-act fund, for example. It's like for like on the way that it's actually managed, but it's in an overseas structure, but you could transport that track record over. So you could run some manual quants on that to see how well it would work. Then that means that the track record element isn't so important. But every time that you deviate away, so if the track record is not 100% transportable, there's style drift or there's some different concentration rules within there, or the AUM starts dripping down below the 50 million or the start capital, then really it just means that it's harder, which basically means that the timeline for actually getting you to a break-even level increases. The real no-no, I think, is that if you have a fund that's really less than about 10 or 15 million, it stands a lot of risk for the fund manager, for the client, for yourselves as the platform for one of their ACD and so on, as well as the sales team, that it could lie around that level for quite a long time, and increases the risk of whether or not everyone sees each party sees it viable going forward.
Yeah, I mean, obviously, you know, we encourage when we work with people like yourselves with this seed capital and accelerator capital as well. But it's also the case of the regular flows that you're looking for, so getting onto buy lists, etc. That's the tough one. Look, it's been great to catch up. We just wanted to do a quick overview on the UK. As ever, it's a great pleasure, and I really appreciate your time. And I look forward to catching up with you very, very soon. So for now, take care.